Generally, our class going into this style, as you know, I'm trying to cover all slides first of all. If you have any type of question, you can write your question in chat side. Then I can try to answer if I see those questions simultaneously. But if we can't achieve to answer those questions simultaneously, at the end of the session, approximately 45 minutes, I'm trying to cover the slides. And the last 15 minutes, I'm trying to give the microphone to all participants and getting their question. If I have a good explanation for their question, I'm trying to explain those questions as well. So, as I say, today we will try to cover the portfolio performance indicators. What we mean by portfolio performance indicators. In the first slide, you are trying to see the S&P valuation measures. S&P 500, meaning that the biggest 500 companies in the United States market. And this slide showing that on the y-axis, as you see, 28x, 26x, 24x. This means that price higher than earnings 28 times. This is a multiples, meaning that your price, the stock price, is higher than approximately 24 times here than its earning during 1 year. So by just looking this valuation metrics, you can directly say that if I take a look at a company and to decide whether invest or not, I first decide whether this company is cheap or expensive. So the price earning ratio is a good measure, first of all, in the outside condition. We will enter the kitchen, we will go in details as well, but for the outside outlook of the company, the price earning ratio is a good measure of whether a company is cheap or expensive. So if the price earning ratio is higher than its average, this means that this company today is expensive. Okay, so if you look at the middle dash line in green style here, 25-year average for the price earning ratio in S&P 500 is around 16.76. So this average dash line showing that during 25 years, this price earning ratio get a measure in average around 17. And here, as you see, the price earning ratio in 2000 is around 24, meaning that it is approximately 50% higher than its overall average. So here you are expensive. And during the global financial crisis in 2008, you are really, really cheaper because your price earning ratio is just 10, but the average line is around just 17. So if you take a position here for your company or stock, then this means that your company will perform approximately, will have an opportunity to get a profit for you approximately 50% during the 2 or 5 years. So, as I say, this is an outlook, first perception for the company's valuation metrics, and price earning is one of the best indicators to show whether a company is cheaper or not. If you take a look at here in this matrix, okay, please take a look at these numbers here. These numbers here showing first line is price earning ratio. This CAPE, meaning capital expenditures, okay? Capital expenditure, the company making, meaning that how much the company making an investment during those years. And if you look at this is average is around just 26, 27. And here, as you see, the latest observation is 29 around. So dividend yield. What we mean by dividend yield? First of all, you should understand the notation here. Dividend yield is this. Dividend yield, we can briefly explain this notation in this style. You know, Tesla is a big artificial learning, automation, motor vehicles, electrical automobiles, and those type of new innovation and technology product and company. And when you take a position in Tesla stock in S&P 500 today, let's say you put a $100,000 in Tesla stock in the stock exchange. This means that if the Tesla today, let's say approximately $50, and if you take $100,000 Tesla stocks, you mean that you will at your hand 200,000 Tesla stocks. And you are a shareholder today for the company of Tesla, meaning that even Elon Musk, who is the biggest shareholder, who is the company owner, right? Elon Musk is the company owner and the biggest shareholder in Tesla stock. But with your $100,000, you are also a small minority shareholder of the Tesla stock exchange today. And let's say at the end of the year, Tesla produced $20 billion net profit. Okay, $20 billion net profit Tesla produced at the end of the year, according to its balance sheet and income statement. Then this 20 billion can be allocated to their all shareholders in terms of their sharehold position, how much stock you are holding. So let's say 50% of Tesla stock at the hand of the Elon Musk, the company owner. So $20 billion net profit, and half of it is the owner of the Elon Musk. 10 billion profit will go to the Elon Musk as a dividend yield. Okay, because Dana Bob, may I request something from you or all participants? Please don't move your mouse on the screen, because as you see, when you draw your line, all the charts and the pictures becomes ambiguous and I couldn't follow my presentation. My ultimate request from all participants that please don't move your mouse. If you have any type of question, you can write your question on the chat line. If you are patient, at the end of the session, I will give microphone to all participants and try to answer their question as well. As you understand, dividend yield is this. According to how much stock I am holding for that company, I will get a portion of the net profit at the end of the year. And this is my dividend yield. Okay. So if Tesla produced $20 billion, and let's say I am one of the shareholders with 0.005% of Tesla, meaning that 0.0005% of $20 billion will come to me as an earning for the dividend yield. So dividend yield means this. So normally S&P 500 during the 25 years, as you see, in average, allocating their dividends 2% as yield. And today, dividend yield is below than the average, meaning that company earning per share and dividend yield performance is not good today. And this PB is price to book ratio, meaning that price, you can have a price and value in the stock exchange, and you can have a real value on the book that you have. For instance, let's say your company has a factory in the Newcastle, and let's say your company making an investment in Manchester. And if you sell this company and its investment in Newcastle and Manchester, let's say it is approximately $4 billion today. But your company also making a position in stock exchange, it is quoted in stock exchange, and its market value is, let's say, 10 billion. This means that your company real value, its building, its machine, it is operation, it is factory, it is investment, the real value is just $4 billion, but people supposing that its value in stock exchange is $10 billion. The $10 billion, its price, And this $4 billion is book ratio. Okay, so if you divide price to book ratio, this means that how much your company is expensive or cheap today, again, you can understand from easily. So if price to book ratio is going up, this means that people misleading and making a misvaluation about your product and about your stock according to their valuation. This valuation is not correct. So price to book ratio should be fair. It should be close, price should be close to their book value. If price diverge from book value, this means that people mispricing their companies. The company they are investing, they are mispricing. And the P over CP here, as you see, it is price to cash flow, meaning that company from their investment, from their operation, producing a cash flow because you are selling product, you are getting money, and this is your cash flow, this is your earning, and the price that you get at the end of the stock. So this is similar to price to book ratio. And if this price to book ratio and price to cash flow is higher, this is not a good signature for you to make an investment for those companies. Okay, so price to book and price to cash flow ratio should be close to each other. Let's pass the, I think this guy put this signature on each slide and it is not going anyway. Please, all participants, don't move your mouse until at the end of the class. As you see here, on the top of the explanation, you will see that United States sector earning and valuation. On the left-hand side here, as you see, I have S&P 500 earning per share and growth estimates. And here I have the sectors: energy, real estate, utilities, materials, consumer staples, healthcare, financial, and S&P 500 average, industrials, information technology, communication services, consumer discretionary. So what can I from here? What can I understand from this picture, this big picture? This big picture showing me that this green line represent the 2023 earning per share, and the black line showing me 2024 earning per share, EPS ratio. What can I understand from easily this picture? That energy product during this year will have a negative earning per share growth. This means that I can lose money because of my investment during the 1 year in energy sector. But if I put my money in the consumer discretionary sector, meaning that, let's say we have consumer discretionary and consumer staples, and the consumer discretionary is like entertainment and those type of things, and consumer staples is like bread, water, the goods and services that you should buy and consume. Okay, and in consumer discretionary, people using those products and their earning per share growth even for 2 years, 22, 23, and 24. It is approximately 20%, meaning that your company increasing their earning per share growth 20% in the consecutive following years. That is excellent for you. And if you look at this picture, this one, let me stop the sharing and share again, because that dash line, that guy's making that dash line and it is blurring the screen. Okay, here my screen sharing again. Okay, please don't move your mouse. On the right hand side, forward price earning ratio on the chart, and this showing that, please look at this. What we say, if the price earning ratio is higher, this energy company is expensive. Don't take a position in this sector. And let's say it is in financial, earning per ratio is really low, right? Today earning per share in 15-year average is energy is just around 15, and the current ratio is just 10. But for instance, in information technology, you know, information bubbles, technology bubbles in all around the world. For that reason, their price earning ratio today is around 25. But their 25 years or 15 years average is around just 15. So today, price earning ratio for information technology is really high. And this company is really expensive. So don't take the position today for this type of companies if you take a position for the long term. Okay. Let's change the picture and let's take a look at not the United States, but European sector earning and valuation. This is Morgan Stanley corporate Europe earning per share growth estimates. On the left-hand side, you will see again, energy is the worst sector. And as you see, financials are the best sector because of the interest rate increase all around the world. Financial companies producing excellent profits, right? All the banks, because of the interest rate hike, they are selling huge credit and they are getting excellent profit because of their credit and loan agreement. For that reason, their earning per share growth estimate approximately 25% in Europe. And let's look at the price earning ratio for the Europe valuation. And it is something like the current ratio is just around 6, but the 15 years average is 12 for the energy, meaning that energy sector today is cheap. Okay, you can take a position in energy in Europe. But let's look at this one. Real estate. It is again so cheap. 15 years average is just around 18, but today the current ratio is just 12. But let's look at healthcare sector. The picture is changing. Price earning ratio currently is around 17, but average is 14. So current ratio in price earning is higher than the 15 years average. So the healthcare sector in Europe today is expensive. If you take a position, you should wait longer times. Okay, you should take a position according to price earning, valuation metrics, and earning per share growth estimates in the stock exchange position. And let's change the picture and look at the Australia right now. And information technology for Australia, it is really bad this year. But the industrials, because of the commodity prices, industry is producing excellent profit in iron ore products in Australia, because iron ore produced generally in Australian continent, and they are really producing excellent profit during this year. But their net profit will really decrease earning per share estimate for the next year from around 60% just to 10%. And if I look at what will be the next couple of years price earning ratio in these sectors, energy today is cheap because it is less than the average. The materials is around just average. But let's look at healthcare or the communication services. Communication services saying me that the current ratio in price earning is around 27, but the 15 years average is just around 17, meaning that today communication services in Australia is really, really expensive, and don't take position in this type of sector. Okay. So let's change the picture and let's look at the correlation and equity return analysis in the stochastic performance indicator. On the left-hand side, on this chart, you can take a look at forward price earning ratio and subsequent 1-year return. And as you see, they have a negative correlation. If the price earning ratio is higher, your return is less. Okay, what we mean? If price earning ratio is higher, your return is less. Because price earning ratio is a good indicator for me that if the price earning ratio is going up, my company is expensive and it will be given a less return, lower return during 1 year. For that reason, if I get a position in cheaper company, meaning that price earning ratio is lower, my 1-year return will be high. They have a negative correlation. As you see here, this line showing that there is a negative correlation between price earning ratio and 1-year return. And if I make this return for 5-year analyzation, price earning ratio for 5-year has really negative correlation, approximately 31% with the 5-year annualized return, meaning that if 5-year price earning ratio is really high, my return, my profit in that company will be really lower, or vice versa. So if I take a position which has a lower price earning ratio in the stock exchange, in the 5-year annualized return, I will get an excellent profit at the end of the 5-year. Let's look at this picture now. This showing that S&P 500 valuation dispersion. What we mean by valuation dispersion? Valuation dispersion showing us that if I take a picture from the 1996 till now, approximately 30 years or 27 years today, the median S&P 500 price earning ratio is volatile in this range, but the valuation spread is between 11 and 14. So if this valuation spread is converging my S&P 500 price earning ratio, this means that I'm in a good position in that company and in sector or in index. But is this valuation dispersion like a confidence interval opening their gap as a dispersion analysis? At the end of the period, I will get a huge loss if I take a position in this index. And please look at this corporate earnings. Corporate earnings means like Tesla, okay? Not the government stocks, not the fixed income securities, but the corporate earnings for the corporate firms or private sector companies that we see. And the corporate earnings and sources of earnings of the growth. On the left-hand side, I have S&P 500 earning per share, the meaning that it is EPS for the S&P 500, and it is index annual operating earnings. Okay, indexing annualized operating earnings in United States dollar. And this is generally the green line showing earning recessions and the blue line showing us the consensus analyst estimate during the 1 year. So in the 2024, as you see, earning per share for S&P 500 will be excellent. So if you have a money in your saving and if you want to take a position for your investment, you can take a position in S&P 500 for the next year, not today, but the next year S&P 500 will give a nice profit for you for the 2024. And on the right-hand side, as you see, S&P 500 year-over-year operating EPS growth. This is a good metric. Why? Because it is not giving a direct nominal numbers for the EPS. It is showing how much earning per share will be growth during 1 year or during 2 years. And on the y-axis, I'm showing the percentage, and on the x-axis, I'm showing the dates. And today, as you see, these charts, especially after the crisis, EPS growth will be huge and excellent because of the base effect. Look at it here, 2008 global financial crisis. Because EPS directly contracted approximately 40%, then in the next year, it is approximately increasing 15 and 47 index. Okay, so if you have a contraction in a crisis period, the next year will be a huge position and opportunity for the EPS growth. Look at the COVID crisis period right now. Here we have the COVID crisis. The EPS growth contracted approximately 22%. And in the following year, just 1 year later, the EPS growth will reach 70% in all around the world in S&P 500. Meaning that people generally sell their products and companies in the crisis period, but this is not correct. if you are a good investor, you should increase your position in the crisis period, because for the next year, you will get a huge profit because of the EPS growth and dividend yield that you get. Okay, the panic selling, the short selling in the stock exchange, especially in crisis period, will trigger the people to sell their product, but this is not a good decision-making process. This is not a good strategy to make a position in investment banking or investment sector. And look at it now, profit margins. On the left-hand side, I have S&P 500 profit margins. What the y-axis showing? It is showing just the dates. And these are the profit margin. So approximately 30 years, S&P 500 profit never exceed 14%. Okay, so this meaning that normally, if you are taking a position in S&P 500 in any stock or in average, your overall return and profit margin will be around 15% during the 1 year. Okay, but sometimes it can be really contracted, like in the financial crisis and like in the COVID crisis. This can be a contraction period, but if you look at the longer trend here in this picture, normally the S&P 500 net profit margin in 1990s is just 4%, but today S&P 500 profit margin is around 12%. What we mean by this? At those times, 30 years ago, companies producing good products, producing nice product, selling them to abroad and international market, but their profit margin is really low. But today, maybe because of the technology, because of the globalization, because of the mobility, because of the easy access to their products, company increase their profit margin and decrease their cost. Let's say 30 years ago, to produce an Apple iPhone cost a company for $1,000, but today it's cost just $100. So cost is decreasing and technology is increasing, artificial intelligence is increasing, machine learning increasing, so automation process, and during 30 years, companies increasing their profit margin all around the world. For that reason, 30 years ago, the S&P 500 just producing 4% net profit margin, but today it is producing approximately 12% profit margin today. And on the right-hand side, if you look at the profit margin by sector, this is dramatic. In real estate sector, as you see, the profit margin is today is around just 24%, but maybe let's say 10 years ago, it is around 36%. So real estate sector profit margin is more volatile, but on average, our current ratio is just around 24%, but this is a huge number, 20% net profit at the end of the year, if you take a position in the sector. But let's look at, let's say, consumer staples. Consumer staples all around the world has less volatility in their profit margin because people consuming consumer staple because of their mandatory measures, let's say like water. Without water, you will not live. But every day you are drinking 1.5 bottle of water, right? So nobody consume and increase their consumption of water during 30 years from 1 liter to 5 liters, right? Every day I'm consuming same amount of bread, same amount of meat, same amount of chicken, same amount of butter. So the profit margin is same for those consumer staples. But in utilities or communication services today, because people are using more different style type of products in technology, communication services has a huge volatility as well, and their profit margin today around 18%. This is a huge number as well. And also I want to take a look at the financials, the banking sector. As you see, the banking sector and the financial market producing today approximately 18% net profit margin. And this is a huge return, because all this return in USD dollar, not your local currency. Okay, this is a return in United States dollar 18% during the 1 year, and this is a huge number. But in industrial, or let's say in healthcare sector, as you see, the average return and the yield and the operating profit margin is really lower. Now let's look at the value versus growth perception in investment decision-making process. Value meaning that if you have a company, long-term company, let's say like Microsoft or IBM, these companies called in financial market as value company. Okay, value company, meaning that they made their most of investment until today. They are producing excellent products to all around the world, and they are creating the value, dividend. But the growth companies are like unicorn, new established companies, and has huge opportunity, but also has huge risks as well. Because Microsoft has a long-lasting company, its risk is little lower. But if you take a position in a growth company, it can produce 100% profit for you in 1 year, but next year it can go at bankruptcy as well. We don't know. For that reason, we are calling those companies as growth companies. They can bring a huge opportunity for you, but they can also create a huge risk for you as well in investment making decision process. On the right-hand side, we are trying to look at S&P 500 operating leverage by sector. Leverage means how much you have a debt and how much you have your own equity. And if I divide my debt to my equity, my own capital, this will give how leveraged I am. So let's say I put for my company initially $1 million, and from the bank and from my friends, I took approximately $5 million as a loan and as a debt. One of them is short term, one of them is long term. Let's say friends is short term and the bank is long term, but the overall amount of the debt is 5 million. My own equity, my own capital, my money is 1 million. So I am leveraged 5 times higher. So if I have a problem, my own capital does not be adequate to pay my overall obligation, debt obligation. So if a company has a low leverage, this means that you can take a position in these companies as well. Low leverage companies, meaning that managing capital themselves. So they can put their capital expenditure initially without paying additional debt, without market capitalization increasing, and without going any type of bond issuance or any type of new loan application. Okay, those companies can make their investment according to their initial capital. And this is a little bit detailed analysis, but I want to take a look at this interest rate coverage ratio here. This is a good indicator for the company valuation and company performance indicator as well. Interest rate coverage ratio, please look at this explanation. Interest rate coverage showing this amount. EBIT over interest rate expense on debt, meaning that EBIT means earning before interest and taxes. Okay, interest expense and taxes, your earning, operating earning. Okay, and if your company's operating profit can pay their interest expense, this means that, look at this one, this gray line and this green line here. Small capitalized company just pay their interest rate debt 2 times higher with their EBIT margin. But large capitalized firm can pay their interest expense 8 times with their EBIT, meaning that with their operating profit, they can pay their interest expense 8 times higher. So their health and their robustness is good. They are robust companies. But small cap companies, if they have a problem, this ratio, if decrease less than 1, what does this mean? You have a debt, you are not paying the whole debt, but you have problem even while you are paying the interest expense on that debt. Okay, this is a huge problem for you. You are not paying the debt, but even you have problem while paying the interest expense on the overall debt. This is a huge problem for you. So this interest rate coverage ratio should be really, really higher for the companies for their health and performance. And here, if you look at the annual returns and intra-year declines, you will see huge volatility in the capital and investment market. So while taking a position in capital expenditure, in stock exchange, in option pricing, in derivative market, you should first accept that these companies, these positions are not like the loan or deposit in your bank. These are not like the government bond and securities that you paid. These are risky assets. Okay. While, for instance, if you are going to an investment banking, while you are opening an account, they are generally asking you that, what is your risk perception? They are asking first question, what is your risk perception? And 3 alternatives you have: risk aversive, risk loving, and risk neutral. If you click the button there, I'm a risk aversive person, the company is saying you that, please don't take any position in derivative market. This means that you are risk aversive and the derivative market is really high in risk asset. So to take a position as a risk aversive person in derivative market will really affect your mental health. Okay, so if you are a risk aversive person, you should go to lower risk asset like fixed income securities, like Eurobond, like deposit in the banking sector with fixed return. But if you are a risk loving person, you can take even in option pricing, even in derivative market as well. It is up to you. But you should first ask yourself, how is my risk perception? And if I put $1 million in investment, how much money I can tolerate to lose in this investment? If you can't tolerate 10% losses in investment, you shouldn't take a position in the stock exchange. Even you can lose 20% in one day. Okay, you should first ask yourself, what is your risk perception? Then you will decide which type of asset you will buy. For instance, you are really, really lower risky person, then you can go to the government bonds and treasury bills and take a position and fix return, let's say 5% at the end of the year without any risk. But if you take a position in investment banking, in stock exchange, their valuation and their volatility is really high. Global equity market, as you see on the left-hand side, we have US S&P 500, Europe excluding United Kingdom, emerging market, and selected countries here: Japan, United Kingdom, France, Canada, Germany, China, Taiwan, India, and Brazil. And as you see, generally, emerging market, if we take a look at their average, emerging market generally has a lower return in the local currency. But if we take a look at what is the problem there and what is the general perception, especially look at this one, 15% losses. And in the United States dollar, because of the depreciation, it is increasing to 20%. Meaning that if there is a volatility, if there is a risk in the market, emerging market loses more capital than the developed market because of the risk perception. Capital outflow come across in the emerging market. So if the Israel bombs the Palestine today, the value of the Brazil stock will decrease more than the S&P 500 in the United States. Because if there is a risk in the financial market, the emerging market stock exchange lose more than the developed market stock exchange. This is the risk perception. And here we have cycles of the United States equity outperformance. And as you see here, in just 6 years, United States metrics increased 300%, meaning that you are taking a position $1 million, and in 5 years, it is increasing $6 million or $3 million in 5 years. And if you take a position here at the end of the 19th, 1 million, in 6 years again, it is increasing $2 million. And if you take a position here to triple your investment, it should take approximately 15 years. Here, just 6 years. Here, just 4 years. Here, just 5 years. But here it is around 15 years. So timing is everything in financial market. Where you are taking the position, at what time, at which cost, it is really important. An international valuation and dividend yield here, MSCI all country indexes excluding the United States. If we take a look at here, during approximately 20 years, the price earning ratio is really decreasing for the MSCI World Index, meaning that last 20 years, performance indicator is not a good, especially in all around the world, if we exclude the United States, and if we look at the price earning ratio. On the right-hand side, as you see, difference in dividend yield with United States, dividend yield is good. Look at this explanation, MSCI all country world, excluding United States minus S&P 500, meaning that I'm excluding United States from all over the world index. Then I'm spreading this index from the United States, but the dividend is good. Dividend is meaning that every year I'm taking approximately 2% of dividend from my investment, rather than independent from the price performance of the stock in the stock exchange. I'm getting this dividend yield each year. And from my last slide, I want to say here, international equity earning and valuation. What we mean by here, international equity earning and valuation, look at this one. Consensus estimate for global earning. And this is the open blue, the light blue is Japan, the purple is China, EM, green Europe, and gray is US. And look at it. As you see from the charts on the left-hand side, Japan and the Europe is lower, but the United States and China is higher. China is the motorcycle and motor driver of the world stock exchange. If China stop buying stock today, we will lose all of our money. They should continue everything. If China consume one more bread every day today, most of the African countries will not reach any type of bread all around the world. So the demand coming from China is really important for the global macro indicators for the all over the world. And on the right hand side chart, please look at this as well. Global valuation. It is current and 25 years average. And look at this one. 25 years average is here, and the current is higher than that. And in the COVID period, it is really hard. For the Japan as well, Japan less than it is average, meaning that you can take a position in stock exchange in Japan, it is cheaper. But I can't say the same for China or EM. Okay, but the Europe as well. Today, the valuation is just 12 for the Europe, but the overall average is around just 15%, meaning that Europe and Japan is cheaper, United States and emerging market is expensive for to take a position in the stock exchange today. So